Hello everyone, welcome to today's webinar, Key Aspects While Investing in Startup, a workshop on how to evaluate startups hosted by CFA Society India. I would like to take a moment and welcome our audience from around the world joining us remotely. I am Swapnil Sagar Vitlani, Managing Partner at Cumulative Ventures, and I will be the moderator for today's webinar. Before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is scheduled for about 60 minutes. We'll be leaving time for Q&A after the speaker presentation. Please feel free to put out your questions throughout the presentation on the right-hand bottom of your screen under the Q&A question box. Post the presentation, we'll value your feedback. So please complete the evaluation survey before you sign off for today. Now it's my pleasure to introduce our speaker for today's webinar, Rajesh Shaigal. Rajesh is the founder and managing partner at Equanimity Investments. He has been a seasoned investor with a dual focus lens on private market as a VC and angel investor and a public market side as well for over 2 decades. He has a deep understanding of Indian entrepreneurial and innovation ecosystem. He has been an active member of Mumbai Angels, TIE, NASSCOM 1000 Startups, so on. He is a Wharton alumnus and a CFA charter holder. Over to you, Rajesh, to take us through the key aspects while evaluating startups.
Thanks, Swapnil. Am I audible clearly?
Yes, sir. Loud and clear.
Great. Thanks for this. And let me, welcome all participants here. I'm told people have signed in from all over the world, different parts of the world for this conversation. So I'm very delighted to be someone who can share my thoughts. We were discussing as to what all aspects we can cover in this 1 hour. And I can assure you that when you're investing in startups, the key aspects that you have to keep in mind, which is the topic of the day, I think 1 hour will not do any justice to this whole thing. People like me have spent our entire careers trying to figure out, what all to keep in mind when we invest, what's right, what's wrong, what works, what doesn't work, etc. But I think what I've done is I've put together a few slides. I think the slides are just a marker for us to have a conversation, really. So what I request is, as I go through these slides, please keep your questions ready. You can put it in the chat box, or and Swapnil is going to do the help us with making sure that questions that are relevant, questions that are going to answer many people who are asking questions that answer many issues in everybody's mind will get done. So I'll just let me go through the motion without any ado. So how do you evaluate startups, first of all, right? What are the key aspects? In my experience and in talking to a lot of people in the ecosystem who deployed money behind startups, backed startups, successful ones, unsuccessful ones, etc. I think one of the key things that all of us agree on, there are many things that we all disagree on, but there's one thing that we all agree on, is that the key to a successful startup, and therefore key to making a successful investment in a startup, is the quality of the founding team. And I think this just makes sense, with my experience of investing in public market equities since the early 90s, private equity investments since 99 onwards, and a variety of other asset classes. I think what distinguishes investing in founders who are starting off is that when you start off, there is really no history. There are no 5-year annual reports, financial reports. There is no third-party research available on the problem that the founders are trying to solve. It's all very new. It's completely blue sky. And I think the only thing that we can be sure about as investors when we are backing startups is the quality of people. So we tend to spend an inordinate amount of time with the founding teams, and there's no shortcut. There is no other way, and there is no formula that I can share with you saying, what, if these 4 things tick, you can tick off these, then the founding team is good. Unfortunately, it's not like that. Fortunately for people like us, it's not like that. So this is a very, very subjective kind of assessment. It's like what we do in life. You meet people, some of them become good friends, some people you don't like, some people you get along with, etc. So there is something in some compass inside you which is directing you, saying, okay, these are people, this is someone I want to befriend, this is someone I want to spend time with. And I think that's what startups are all about. You meet the founding team, you try to assess whether these are the people that you want to spend the next 5-10 years with, because these are not listed companies. So you can't, if you don't like, you can't sell tomorrow. There's no exit, there's no liquidity. So these are really truly long-term investments. So what we look for at Equanimity is experienced management teams, and I think we also try to make sure that if there are 2 founders, 3 founders, do they really have a shared vision? And that's extremely important. And therefore, what we usually do, typically, and I would recommend we all keep this in mind, is meet them as a team a few times and meet them individually a few times, and try to assess if they're all working in the same direction or not. Because the last thing you want are 3 rock star co-founders of a startup who are really trying to address a very nice, large opportunity, but they're all working in different directions. So shared vision and cohesive culture within the startup is extremely important. Coachability, I think this is again pretty subjective. And the reason I put that term here is you will find startups, being founded by people with 15, 20 years of experience. And you also have startups which are founded by people who are still studying in college in an IIT or somewhere else, right? They're still pretty new to the business world. And I think one thing very important for any startup success is that the founders or the founding team has to keep an open mind. It's very easy to say, let's keep an open mind. We all think we have an open mind, etc. But I think you will realize as you experience that if you formed an opinion of something, it's very difficult for anybody else to change that. And that, is true for founders as well. So what we are saying as investors is not that founders should listen to you, but what we are saying here is founders should keep an open mind and they should be coachable. So if you nudge them in a certain direction, whether they move in that direction or not, they should keep an open mind and judge for themselves whether this suggestion that's coming in or this nudge that's coming in is going to be helpful for them in their journey or not. The next 2 points are, I can't stress more on that. Adequate skin in the game. I think this is a battle all the time. So when you start off a business, there is always a lot of skin in the game because you are bringing your friends, family, everybody's money, your own money, your time, your career, everything you're aligning with that startup. But I think as a startup starts to mature, as you taste success, success comes at a price. So the price is dilution. Founders then from 100% will become 80%, 50%, 30%. I mean, and you look at all very successful startups, by the way. A good example is Zomato that just got listed, and investors made tons of money on that. But do you know what's the stake of founders in that? It's single digits. So that's the price you pay, right? But as investors, what we always try to ensure, and I think founders should also they always do keep this in mind, is that they always have a significant stake or a sizable stake in the firm. Of course, as the firm grows, then there's a compromise that you need to make. One thing that we keep hearing, when we meet startups is, are you looking for only IIT-IIM founders? I've been told that you back only IIT-IIM founders. I've heard that so much that what we started doing now is when we invest in, when we put together a portfolio now, we look at the backgrounds as a hindsight, in hindsight. So what percentage of our founders are from IITs and IIMs? And I think this was a very relevant question about 6 years back, where most investors, would actually look for IIT, IIM pedigrees, etc. And I don't think there's anything wrong in that. But the startup ecosystem in India today has matured well enough that we don't have to really seek founders just because of their educational pedigrees. There are enough and more founders who have been there, done that, experience behind them, etc. I think those first 3-4 points are far more important now than the fifth, right? Not to take away anything from any IIT or IIM, but it's not like a qualifying criteria anymore. So this is about the first and most important thing. Swapnil, you were saying something.
Yeah, Rajesh, what I wanted to make it more interactive for participants, that after each slide or couple of slides, we have some polls that will take it for 30 seconds or a minute and see how the audience feel before we move on to next. So
Interesting. Yes.
Anlin, can you please put up the poll? Hello, Harshad and Lynn. Yeah. What is the quality of a successful entrepreneur? Is it passion, perseverance, or pragmatic approach?
Sorry, should I stop sharing so that they can put that question there and then I can again start sharing? Will that help?
Yeah, but this is visible as a chat box.
Okay. All right. Great.
And Lynn, people are
We will
unable to
just
see.
wait for 15 seconds more and
There are some chat box that people are not able to view the poll.
okay. Okay.
Yeah. Oh, we have interesting results in terms of perseverance is the biggest quality people feel in terms of running a successful entrepreneurship. Yeah. We can, Harshad, we can move on to next poll about right age to be an entrepreneur. Hello, Anlin, Harshad. Yeah. What is the right age according to you to be an entrepreneur? Is it the early 20s and 30s, 30 to 50, or any age can be the right age for to start off your own, like the founder of KFC? Oh, any age is the right age to start. Great. Thank you, everyone.
Excellent. Excellent.
Yeah.
So I think, I think these were very interesting answers. So perseverance is indeed extremely important when you're starting up. Uh, only one word of caution that there is no right answer in this world. So, you have to draw some line in your mind saying, grit is important, perseverance is important, but there's some time, at some point in time, I have to realize that I have to pivot or I have to change, right? And I think founders are, because on their journey, it's very important. They all are aware of that. And I think the right age to found a startup or to start off, really, there's no right age. But let me tell you, let me quote a study from the Harvard Business School, where they did a research among all unicorns, and what they found out was very interesting. The average age of founders of unicorn companies, right? So we all want to invest in a unicorn. The answer was 41 years or thereabouts, right? So I'm not saying that you wait till you're 41 you start off, but that's just sharing some information there. Excellent. Let's go to the next slide. So after the founding team, the next important thing where we spend a lot of time in analyzing and understanding, how to assess the startup, is it good, bad, ugly, whatever, I think is to look at the business model before anything else. It's even before looking at the market size and all that, which is extremely important, and we'll get to that. But you have to look at the business model with one caveat. So you always keep in mind that the business model that you're investing in or you're assessing the business for can change, right? As we all know, so InMobi started off as a very different business model, right? Zomato was very different when it started than what you see today. And Paytm was very different when they started than what they're doing today. So business models will morph. And therefore, so just keep this in mind as we go through the following points that we have to look at when you're assessing the business model of a company. The first is sustainability. I think it's extremely important. Whatever the founding team is trying to achieve, whatever problem they are trying to solve, whatever market they are trying to go and create, or they're capturing somebody else's market share, are they doing this in a sustainable manner? And nowadays, one of the most often repeated terms in our investment fraternity is ESG. We all talk of ESG frameworks, etc. And and therefore sustainability is a key part of that. But when we are talking of sustainability here, it's not pertaining only to the ESG aspect. It's more about, are they running this business in a way that it remains sustainable? Because remember, the key at the startup stage is cash flow, right? How much are you just burning money? And if you're burning money, do you have access to a large pool of capital behind you? Or are you running the business in a way that it is generating that cash flow to help you survive? So I think survivability or sustainability is key when somebody is pitching a business model to you. The other important aspect, obviously, is value prop. So whatever business you're trying to set up, is it solving a real problem for somebody? And who is that somebody? What's your target market? Is it a very niche market? Is it mass? Is it premium? You got to be very clear about what is the value that the startup is providing and to whom. Yeah, because if you are not solving a real problem for a sizable set of people or people who have the ability to pay sizable money to make sure that they avail your services and become customers, I think sometimes we just get lost in saying, oh, this is a good idea. Good idea doesn't make the cut. So good idea is great, but is that good idea solving a real business problem? And logically flowing from there, you have to also then start asking few questions about how is this business model going to address the market? So what's your go-to-market strategy? What are you planning? Are you going to distribute only digitally? Is it a business model that has to be digital and physical right from day one? Or like, for example, Nika, you start with online and then you logically go into offline, Lenskart, and there are many such examples. Or you start offline and then you transition into online, a host of examples there, or you start both of them together. So it's very important to know what's your distribution strategy going to be, what's your pricing going to be. Are you going to be a subscription model? Are you going to be, mass market and therefore priced lower than competition? Is that your strategy of gaining market share? These are the questions that one needs to understand and answer for oneself when we are assessing startups for investment. And this derives its value from capital efficiency. And at Equanimity, again, one of the key investment thesis that we have is capital efficiency. In today's bull market outside in the financial world, both on the listed side and unlisted side, literally every week you're seeing one unicorn being formed. Getting 10, 20, $30 million is just seems to have become so easy. I can assure you it is not, but it seems when you read press and press reports, every day you see 10 million here, 20 million there, 100 million here, what's happening? So even I think in today's market, euphoria, I would really ask you to be a little cautious and remember that whatever money you're raising is to build a business in India. And let's all please remember that India is still, even today, a very poor country, right? And you just have to look at the macro statistics to understand that, or just go out of Mumbai, Bangalore, Delhi, whichever city you are in India, and you see the real India. That's India, right? So India is a poor country, and therefore, if you want to build a very sustainable business, you have to be extremely capital efficient. I'm not saying that if you're building a business for US, you don't have to be capital efficient just because it's the US and there's enough and more capital to go around. No matter where you're building a business, make sure it's in a way that's very capital efficient. And as an investor, we assess capital efficiency a lot. And see, at a startup level, capital efficiency cannot be measured by ratios like return on investment or return on invested capital, etc. Because there is no return. The startups are not making money. So how do you assess capital efficiency? There are quite a few ways. I think a simple yardstick that we use is to say, okay, this company, there are 3 companies or 5 companies addressing a certain market. One guy has raised $3 million. The other guy has raised $1 million. There's a third company that is completely bootstrapped. There's another guy who's got a $10 million raise, etc. Now, how have they utilized that capital? What have they built from that capital? Number of users, traction, technology, distribution, reach, whatever metrics, you got to measure and compare and assess for yourself who's more capital efficient, right? And of course, replicability in your business model, whatever works in, let's say you launch in market A, let's say you started a business in Bombay. And is that business model replicable in Hyderabad or a Bangalore or a Pune or an Indore? So you got to think of all of these questions as an investor when you're assessing startups. Yeah. Swapnil, you want to ask some more questions in terms of the poll that you have?
Yeah, we have one poll on, as you have said, that founding team is very important with dual founders and having the passion and the coachability. And on the other side, you are also saying that business model needs to be important. So we are saying, what do you think is the most important aspect while evaluating? Founding team, business model, or the market size? So founding team on the one hand can understand and develop a business model which is sustainable enough and more capital efficient, or is it the good business model with a not so great founding team, or both of them are not there but market size is huge?
I'm waiting to see the answer, the results of this poll.
Hold on for another 10 seconds.
Oh, equal to founding team and business model. That's really great. We can move on to next one.
Okay, excellent. So founding team is more or less equal to business model in terms of importance. And I think market size is not that important, seems. Okay. As I said, this is startup world. There's no right answer. So they are just beliefs. Okay. So I think after you convinced yourself that you're backing the right set of people, the founding team is great. In terms of the business model, you're saying, okay, this business model can keep changing, but what they're trying to do now is, it passes my muster. I like what they're trying to do. The next question is obviously, you have to evaluate how big can this become. That was the third aspect that Swapnil just asked you in that poll, market size, right? So who's a target market? Is the target market large enough? Is it a niche market? You got to now analyze all of that. And then that will determine whether your business model that you're bringing to this market is going to be scalable or not. So a few things that you have to look at. One, obviously, is market size. This is the trickiest of them all, for a very simple reason that startups mostly are trying to address, are not trying to address existing markets. They're trying to create new ones, right? So it's kind of like crystal ball gazing for the team. And therefore, because you're going to be partners with the founding team for you as well as an investor. So it's complete crystal ball gazing because market, there is no market, right? I mean, imagine a payments market when Paytm went into payments. There was no market at the time. So it's about vision, right? And this is also aligns again with the founders' capabilities and their background and their vision and all of that. So market size is the trickiest of them all. The only way we get some kind of assessment of the market size is by looking at what's happened in other geographies, right? Or what's happened in other incumbent businesses. So for a payments example that I used earlier, banks, or non-banking companies. So what is the payment ecosystem in this country at that time? How much of that can be digitized? How much of that digitized market can be taken by mobile? So you got to filter and figure out how big can this market size be. The only aspect that I want to share here within this market size assessment is when you are analyzing a startup and you want to understand what's the actual market size these guys can target. Make 3 or 4 scenarios, right? And your business model that you've made should be able to address the worst case scenario with the best case scenario and everything in between. Because your business model has to be robust enough, and obviously as a startup level, you will keep tweaking everything about the business and the business model. So as I said, market size very tricky but extremely important to understand. You do not want to be an investor in a company that is addressing a very small market size and there is no scope for growth beyond that, right? At the same time, you don't want to be putting a little bit of money, small check sizes in a company that is addressing a huge market size but doesn't have the capital or the vision to really address that market size. Because you can be sure in a country like India, you will have 10 guys trying to address the same market at the same time, right? So you really have to be fast, and you have to position yourself well, and obviously you have to make sure that the way you are tackling that market size, the way you have built your business model, there is some inherent competitive mode that you're building. That's your USP, that's your competitive advantage. And if you can't answer this question for the company, and you can't understand what's the competitive mode that this company has, this startup has, then I can assure you there's a big challenge, right? So you have to force yourself to think. Please remember that you're thinking about a market size where the market doesn't exist. It is going to become. So all of these questions therefore become a little more second derivative and third derivative thinking. Market in if that market is there, then what should be the competitive mode? And then how should we position the business? And will that business model addressing this market be really scalable? And I think the most important most important aspect is timing, right? I don't think timing has been given the importance that it should be in the life of a startup. So you may have the best founding team, you may have figured out the right business model to address that market, etc. But if your timing is not right, either you're way earlier than when the market is ready and the market is not ready, or the market is already ready, there are already some players and you are late to the party. I think both are scenarios where investors, truly shy away from. So you have to make sure that you are backing that startup and the founding team, right, with that business model that they said they're going to use. You're backing them at the right time. Again, this is startup world. I have to repeat that there are no right answers, and it's always very easy to say in hindsight, "Oh, that business was a little early. That business should have been done today." But remember, as investors, you don't have that luxury. You have to really figure out and see in the future that today is the right time to start and to back this business and put money where your mouth is. So this is about target market, scalability, etc. Swapnil, you will have another question after this?
Yeah, Rajesh, what I wanted to understand more also in terms of when there is no market, like niche market has been created, then how do you say that whether this is going to fly or not while convincing yourselves internally, right? Like if let's say 10 years back Paytm had come and I will disrupt the entire payment space, how do you take a call whether Paytm would need 5,000 crores or 10,000 crores to burn? Because as we see today in the hindsight, we are saying that this is a huge burning type of exercise. But how do you take the call on the founder as well as on the market sizing typically?
Yeah. Tough.
I have a poll. Yeah. Whether
there's no easy answer.
Yeah, it is a catch-22. If there is a large market and no funds, you're writing a small check size, which will not help, or there is a niche market where what you can say, it is about deciding whether to sell one Mercedes or 10 Maruti vis-a-vis.
Yeah.
Anyway, can
absolutely.
we put up the
Yeah, you're putting up the poll, right?
Yeah. Not this one, Anilin.
Can you please repeat the question once?
Yeah, I have put you up in the chat box as to what market sizing you would prefer. Niche market vis-a-vis mass market. Well, what is best? There is no right or wrong answer. Oh, okay, there's some technical challenge. We can move on to next, and we'll be able to cover that part as a part of Q&A.
Sure. All right. I think this the next slide talks about unit economics. Again, a term that has been bandied around very loosely all over the place. But I think unit economics is something that from a startup point of view, it's extremely important to understand. And I can assure you that no amount of financial modeling or artificial intelligence using models, algorithms that you build can answer this question. Because remember that the market size itself is crystal ball gazed. So there is no real market out there yet. And you're saying, okay, this market will become, $5 billion in 3 years' time or some such numbers. But I think it's the problem with this unit economics term, and I'll be, this is, I think, a great forum to discuss this because we're all CFA related people here, is that people with a lot of financial modeling background come and look at startups. So they start building models and algorithms and, all of that fancy jazz that we keep learning. The CFA Institute keeps teaching us. But remember, investing in early stage startups is 80% subjective, it's 80% art, and maybe 20% science. So you'll be well served if you keep this in mind and remember not to waste too much time on making too many assumptions about building a financial model. I'm not demeaning financial models. I mean, I have done financial modeling for 20 years of my life, and I see the value in those. But I think the value in that theory, and we all know that financial theory goes back to the early 50s when the first time you had some portfolio theory coming out.
Hello. Yeah.
Sorry, Swapnil, you able to hear me?
Yeah. We missed few seconds. So.
Okay. So financial theories, right from Markowitz onwards, started in the early 50s, and that is so the financial theory to value companies and to understand financial modeling, all that is relatively new. We have a long way to go, and most of those theories, most of those models are applicable to mature businesses, mature markets, not to very early stage companies. But that does not mean that we don't model at all. As I said, it's the 80-20 rule, right? So 80% of your time, in my opinion, should be focused on subjective issues, on the art part of it, and 20% on the objectivity of the model or the science part of it. And unit economics falls squarely in this 20%, but it derives, all the numbers here, all the assumptions that you're going to make is coming from the other 80%. So if you've understood the quality of founders and what they can do on the ground in terms of execution, if you've understood the market sizing and how big this can be, if you are comfortable with the business model that is addressing that market size, all the things that we discussed so far, then your understanding of deriving this unit economics for that business is really close to what reality can play out. It's very probabilistic, by the way. So as I said, it's all crystal ball gazing, but having a good handle on unit economics is extremely important. Does it mean that every sale you make, you have to always make money? Of course not, right? Not at the early stage of the business, because the requirements of the business at an early stage are very different than the requirements of a late stage business where you have to make money and you have to be unit economics positive. But you have to have some view on paths to profitability. And before that, you have to have some view on path to revenue. There are startups which are started off even in countries like India, where there is no path to revenue. And when we have this conversation with founders, they completely truly believe that it is not about revenues, it's not about profits. All of that will follow at some point in future. We don't know when, but what we need now is to build this model and get as many people to come and use our service, right, for free, for example. But as an investor, you are partnering the founder, so you have to believe the founding team when they say all of that. But as an investor, it's our fiduciary responsibility and duty to figure out and make sure that we at least understand from a financial point of view that this business model will at some point in time, have a path to revenue and a path to profitability. And I think scaling up the business is something that we keep talking about, but as businesses scale, they obviously have an impact on unit economics, and you'll be surprised to see that it's not always what you expect it to be. Sometimes scale brings in, better unit economics. If you have not done a good job at your business model level and you're targeting which market you're targeting, your scale will actually destroy value in the company and the unit economics of your business. So this is a very tricky part of it. But as I said, if you understood that 80%, the art part of it, then this 20% will actually be depicting what reality can be in the near future for the company. Swapnil, on to you. If we have solved the technical glitch.
No. We don't have a poll for this unit economics.
Okay. All right.
Because it is fairly mathematical. So we thought,
Absolutely.
what are the art part of it? Let's learn the art part of it.
Thank you. I thought you'll put in a question saying, please solve for this. A, B, C, 3 options. What is the value of this business?
No.
All right. So let's go to, an area.
$1 million question.
Truly $1 million question. As investors, this is the big challenge we have. How do you value startups? And you will hear all kinds of views on this. And I think, let me go back to the Zomato example, which is, very fresh in memory for all of us. At the price at which they were planning the IPO, at the value at which, or the price at which the IPO happened, and the stock price after the IPO, and now we have, all of that data. We've seen all of that. Now, which one is the right value of the company? Right? Not the market price, not the price, but the value. What's the true value of Zomato? Some people still firmly believe that this is, humbug and there should be no value. It is completely overpriced. There are other people, on the other hand, who are buying the stock every day. Right? It falls 5%, more and more people queuing up to buy. So like everything else in the market, at least the stock market, no one is right or wrong. The only thing is whether you made money or not. So coming back to this topic, I think there are too many valuation methodologies out there for mature companies. You're right from your DCF to everything else. For mature companies, those cash flow based metrics work. For early stage companies, unfortunately, they fail. And I think it's not that the theory has limitations. I think the limitation is in us, in our understanding of those theories, in our understanding of where to apply what. It's not that we have a tool and we're just finding a nail to hit it on, right? If you have a tool, you have a hammer in your hand, you have to be sure which nail you have to hit. So it's the void is in our understanding. And I think our understanding is also developing now. Just to give you an analogy of how I think of startups and how I think of valuing startups, we have to remember that a startup is like a newborn child. It's a baby, right? And therefore, the earlier slide on unit economics, a baby is not going to earn salary for you, bring home. And to expect the baby to do that is foolishness, right? So this baby needs nurturing, needs to be taken care of, needs a lot of hand holding from investors. And we have to do all of that. As this baby grows, let's say into a teenager, then you don't need to do a lot of nurturing and giving food and taking care and cleaning the baby. All of that is not required. But the teenager requires very different kinds of inputs. So the business at that stage needs those inputs. And I think as investors, it's our responsibility to help the founders make sure that the business is getting what it wants. Now, when this baby has grown into a teenager grows into a mature adult and starts earning money, then the question is, where's the cash flow? Paisa kidhar hai? Why are you not earning money? Where's the money? How much salary? Okay, what is the value of all of that? What can I use it for? All of that become important. So this valuation metrics that we use for large listed or unlisted but mature companies do not work here. But there are other methodologies which are out there, which a lot of tools are out there. So many valuation metrics that you can use to value these startups. Caveat here again, disclaimer. Quite a few of them are still very, very nascent, not tried, not tested, and therefore it's very difficult to say this is how you should value all startups. There's no such thing. Is it therefore very subjective? Is valuation subjective? No, it's not subjective. It's subjective. There are ways to do it. For example, a simple way to do it is a relative valuation. You look at 10 other edtech companies that have got funded, and you say, okay, this is the multiple that typically investors are given in the past, and therefore we should have this kind of a range applicable. Very simple way to do it. But will it assure you that you're valuing the startup right? There is no assurance, right? This is the Wild West. Valuing a company, and forget about a company, is a complete Wild West. I can tell you, I've been doing this for nearly 15 years now. I made my first angel investment in 2006, 2007. And I've been trying to grapple with understanding how best to value startups. But there are too many variables. Every startup is so different. They are addressing different markets. They are in different businesses. The founders are bring a very different mindset to every company. And one of the things that all of us should be familiar with is the butterfly effect. So very small changes in initial conditions can result in very large changes as at later stages. In a startup context, too many decisions to be made when the company is small, and even one decision that you make instead of a little left to a little right has a huge impact on whether the startup will at least survive the next stage or not, or if it matures, then which direction is it going in. So that the decision making is very, very critical here. Why I'm talking about decision making is because each decision is a variable that goes into the valuation metrics, right? Each variable has an impact. So therefore, the complexity of doing a valuation exercise at a very early stage is really mind-boggling. And remember, founders of these companies have really, if you have no clue, they really don't have any clue of how to value. I mean, they may know how valuable it is. We may all agree, ye to unicorn hai, ye to banega unicorn. But what's the value today, right? So it's a very challenging thing. But Swapnil, on to you. You have any question on this?
Yeah, we have one or two. Anlin, can you put up the poll?
Yeah, and guys, keep your questions coming on the chat box.
Yeah,
after I'm
I
done
have
with this slide, we can discuss those questions.
I have a lot of interesting questions and views about how to evaluate or think about evaluating. So, Anlin, is it possible to extend the time, because as I see, we will need at least 15 to 30 minutes extra.
We can definitely do that, Swapnil.
Yeah. Thank you.
Wow, क्या हो रहा है?
Anlin, you're not muted, and I can assure you, we all have the same question. ये क्या हो रहा है?
क्या हो रहा है?
No, sorry, my laptop was hanging. So I hope everybody can see the poll.
Yeah, we could see the poll.
Okay.
We'll move on to next one if you have finished this.
No one has taken the poll, so let me relaunch it.
Yeah. Or the audience have understood there are no multiples or EBITDA methods that can be applied to a startup after insightful thoughts from Rajesh.
See, if you get no inputs, Anlin, then everybody's understood there is no right way.
So we're getting a few answers. We'll just hold on for 30 seconds.
Yeah. Oh, everyone still feels that if there is no profit, no EBITDA, you can still take it as a multiple of revenue and value the startup. Good.
We'll take it at that. Well, I'm a little disappointed that this is not an interactive session. I wish this was in the physical world. We would then have a question about, okay, what is revenue for a startup? I've had fun with that conversation a few times.
Right.
Anyway, let's get.
We are launching the second poll.
Yes.
This is more interesting considering the current timelines, where we are having almost one unicorn every week, if not every day. What is the view for next 1-2 years in terms of valuation? Is it just a bubble which is about to bust, or is it just the starting? Oh, everyone, most of them feels it is just the beginning, and very few feel that there is a bubble that is created. Great. Rajesh, we can move on to next slide, which is more interesting that after you do everything, what next? You are on mute, Rajesh.
Yeah. All right. So post-investment monitoring, and I've just included the last two slides with no comments on it. But I think this slide and the next slide are the key to all startup investing. Yeah. So you can either be a venture capital investor and you're investing in startups, or you can be an angel investor and investing in a startup, or you can just be some high net worth investor, some rich dude somewhere who says, okay, I like to invest in these kind of companies, so I'm going to allocate some capital to startups. I think no matter who you are, post investment monitoring is where I can assure you, you will create value for yourself and your investment, and for the founders and for all stakeholders. If you do not get involved with companies after the investment, if you cannot help companies and startups and founding teams after you made the investment, then I have a term for you, and I call them money bags. So these are investors with a lot of money, and they'll just throw money at startups, but they have no idea how to help startups grow. Nothing wrong with that. As I said, India is a very poor country. So in a country like ours, that any kind of money is welcome to the startup ecosystem. So I'm nothing against money bags, but I would rather people like us, CFAs and qualified professionals. I think I would rather have people like us getting involved with startups and truly helping founders in their journey. And help can come in so many forms. It's not just so giving money itself. Deploying capital itself is help. But after deploying the capital, what can you do? So you can help the founders in innumerable ways, right? Simple thing is, call the guy or the founders once a week. Just ask him what's up, and he will spill all his sorrows and ecstasy. The founders are interesting, by the way. On one day he'll be on cloud nine, the other day he'll say, "Why am I doing all this? Let me shut this and go home." So if you want to really enjoy the life of a founder, also call him every week. Just ask them, what's going on, and you will have so many interesting anecdotes to discuss with people and share with people. Unbelievable. But you'll also be able to help them and guide them. Because you're not in the trenches with the founders, you really can have a 30,000 feet view and say, what, I understand that you're very, very involved with what you're doing, and therefore you think that the situation today is very dire and there are problems and all that. But from where I see things, maybe this is a direction you should go in. Maybe this will help you. And I think some such small nudges, some such small help for the founders, it means a lot. So they really, truly appreciate investors who remain involved with them. Again, as with everything else in life, there's a caveat here. So as investors, please remember to draw a line somewhere, helping the founder versus bugging his life off, right? Don't get too, too involved in the business so that he feels that you're now, creeping upon his space. So you to give the founder space, let them do what they want to do. Remember, you're there to help the founder. It's not your journey, it's their journey. Right? You're there as a mentor, as someone who's helping them. So please keep this in mind. Sometimes we get, too involved with some business, right? Because you really like it, you understand it, you have a firm view, aisa hi karna chahiye. We are all of that. But we have to keep reminding ourselves that our role here is, this is not our business. We are not the jockeys here. We are just assisting them in their journey. So post-investment monitoring, we do at Equanimity a lot of things for founders after we put in money. We help them in hiring the right kind of people, because remember, it's about people in the early stages. And not just the founder, it's the whole team that comes after that. Hiring people for them, technology conversations, whether this technology is better than that, should they use this, should they use that, etc. Which market should you address first? Should we address this market? Should we do this? Should we open up 3 markets at the same time? What should be the pricing strategy? How should we distribute things? What's the product strategy? How should the product be? Should we invest this much money in doing this, or should we invest this money in doing that? And these are all very critical decisions, by the way, at early stage. As I said, the butterfly effect. Wrong decisions at an early stage, initial stage of a system, can have very disastrous results later on. So you have to be sure. I mean, I made an investment once, years ago, where the team actually built a tech, right? And it was awesome while they were doing it. But the business grew so rapidly that whatever they had built, believe me, they had to junk all of it and rebuild the whole system. And imagine the stress that you have to go through when your existing, system that you built up, the technology that you built up is now no longer usable, right? And remember, this is not a third party telling them. This is they realizing that what they've built is now of no use. It's heartbreaking. So you fall in love with the tech that you built. So to take a decision of chucking that technology itself is a massive decision, and then building the whole thing up. And what is the impact of shutting down this tech, building a new tech? What is the impact on the business, and its growth when you're really in a very rapid growth scenario? So post investment monitoring is not only for monitoring our investments, it's for making sure that we are helping the founders in their journey and therefore helping ourselves, because that is how you will create value for yourself and for your investment. I have just one more slide after this, which is exits. Right? I think no amount of conversation, no amount of emphasis on this term exits can make you understand how important this is. Please remember that all startups, all early stage investments are illiquid. They're completely illiquid. There's no market to sell that. As much as you can hear, the press now starting to talk about secondaries and there are exits and all that. That is at a certain stage of the company, not at an early stage. So early stage investing, startup investing is fraught with risks. And whatever capital you put in, there is no assurance. A, there's no assurance that you'll ever make money on it. And B, there is no assurance that even when the company is doing well, you will get an exit and therefore you will make money. So as VC investors, what we do at least, and I've done that as an angel also, is that I first figure out my exit strategy before I put in the money, right? And we have a very clear conversation with the founders, by the way, and I think it's very important to have that conversation upfront, where you impress this fact on the founding team that, listen, this is your business, this is your baby, you are married to it. You are going to be doing this for the next 60 years. My fund's life is 6 years, 7 years. I want an exit in that time frame. So as much as I'm trying to help you do all of this, right? The tenure of our fund, if you're a fund, then a fund is a limited life fund. So it has a 7, 10, 12 years life. It's short term compared to what the entrepreneurs, involvement with the business is. But it's fairly long term from an investment point of view. It's not, a day, 2 days, 5 days, 1 month, 3 months, 6 month kind of investment. It's a 5-year, 10-year investment. So I think it always helps to have a very open conversation saying that I'm going to be a partner with you, as an investor for the next 5 years. And we are in it together. But as we, start creeping towards that 5-year time, you will have to help me exit, right? And most founders I have found, they completely understand it. They completely understand it. And we've had founders go out of the way at times to make sure that we get exits, right? Profitable or not, just to assure that you have exits. But this is an area where you can't rely on anybody else. You have to chart your own path. You have to make sure that you've created enough value in this business that there will be other buyers, right? Whether you're listed or not. So if you invest in a startup, it goes to IPO, more power to you, because then you have exit and it's implied that you've made a huge multiple on your investment. Everything in life is great, right? But not every startup goes to an IPO. I mean, in India, for example, we have very few examples of startups that have really matured and then done an IPO. There are a few, but still very few. So please make sure when you're assessing a business, in addition to all the aspects, including post-investment monitoring, make sure that you have some idea of who will this business be valuable to 5 years down the line. Will it be valuable at that time to some large private equity guys? Will it be valuable to some strategic business guys? Will the Tatas be interested in this? Will Ambani look at it? So you have to have all these hypothetical conversations before you deploy your capital. Yes. So Swapnil, that's it for me. If you have any more poll?
Not really. I have poll now. I have lots of questions. So thank you very much, Rajesh, for an insightful presentation. Participants, this presentation will be shared with you over an email, so no need to take or write notes and all. So we'll move on to questions. So how does the replicability work when startup is trying to do some different things? Like, for example, some things are already prevalent in US, LATAM, and other markets, and they're trying to do it in India. How do you look at this type of situations? Like in India, when the Flipkarts of the world started, they have seen Amazons of the world outside India, right? So how do you look at
Yeah.
this type of situation?
Yeah, I think that's a simple one. By the way, please remember, Swapnil, I'm going to take the simple questions and the tough ones are for you. This is a simple one.
Yeah.
I think replicability. So I think India's startup ecosystem has matured over the last few years. There was a whole era from 2012 to 2015, 16, where most business models were based on what has succeeded in other geographies. They would just take it, replicate it here, and you're done, right? And Swapnil mentioned some examples of that. There are so many examples. You think of any large business today, it's taken off from somewhere. But I think after that, since 17, 18, we've seen the emergence of completely new business models, completely new businesses which are addressing India-related specific problems. Right? These are businesses that may not really work in the US. They may not really work in Europe. Right? They're very contextual to India. So when I said replicability, in that it was actually not in this context. My assessment of, or my input there was more on making sure that every business that you're investing in has to grow. Right now, there are different ways to grow. Either you grow in different markets, in different geographies, or different products that you launch. It's a different aspects of growth. Make sure that your business model is robust enough to support your growth with different, if you add more products through that channel, or if you take this business model and take it to some other city, some other geography, some other country, and it should work there. That's a robust business model. So replicability is extremely important, whether it is across geographies or it is across products. It doesn't matter, but the business model has to be robust enough to support all of that.
Right. Next one is, what is the bigger risk that you are seeing? That investing in a bad business and then repenting, or not investing in good ones? Like in the Western side, we have seen people keep a track of their declined company. Like if I have declined the startup for an investment, how are they progressing to monitor that whether they have taken a right call or a wrong call? What is the bigger risk? Not investing or invest? I will try and keep difficult questions for you, and I'll answer the simpler one.
You're touching a raw nerve.
Because as I was seeing one of your interviews, like everyone sees the unicorns that you're having every week, right? But there is a survivorship bias, right? There are more companies that have failed because everyone sees the good part of it.
Yeah. Absolutely. No debates on that. I think of every 100 companies that get formed, if not thousands, there's one that gets onto that unicorn status. And there are so many others that fail. It's very human in nature. We all focus on the successes. We don't focus on the failures. I will discuss my success with you. I will not discuss my failures as much. It's just human nature. And therefore, not much gets written or talked about the failures. But I think there's too much to learn from failures as well. But to answer your question, Swapnil, very interesting question, actually. I think it boils down as a VC, I can assure you it boils down to my process, right? So every investor has a certain process, right? And different processes. There's no right process or wrong process. We all have our investment processes. So the way our process works is that it allows certain companies, right? It allows certain companies to get filtrated out. And allows a certain kind of companies to flow through into the portfolio, right? So just to share some statistics with you, on an annual basis, our team, we are a team of 7 of us, we look at more than 2,000 startups, right? That's a lot, right? In a year, we make 4 to 5 investments. So of all this company, that process has to work robust, in a very robust manner. There will always, so this is type 1 error and type 2 error, essentially what you're talking about, right? Sometimes sometimes that are great investments in hindsight. Now, today I know it was a great investment, but when I was evaluating it was a startup, right? So you do miss those. And sometimes you invest in some companies and you thought they were rock stars and they're duds. And I can assure you that I've done both. And I can tell you that every portfolio has both, right? And why I told you, Swapnil, that's a wrong. For that, somebody will have to visit my office to be assured that I'm speaking the truth. There's a company I met 3 years back, right? Startup. The guy had no business, right? Two guys walked into my office and they had a mobile phone and WhatsApp on it. They said, "This is what we are going to do." I said, "Great. When are you going to do?" He said, "Nee, already kar rahe hain hum log." I said, "So, where is the app?" No, nothing, no app, no nothing, just WhatsApp. We're doing business on WhatsApp. I said, "Great. So, okay, then I have this process. We have to follow this process." He said, "No, but if you want to invest, you invest now." I said, "Yeah, बिना process के तो मैं कुछ नहीं करता हूँ. Can't do it." And this is a true story. So, of course, we didn't invest in that company. And that company is more or less on the verge of becoming a unicorn today. This is under 3 years. The worst part is, उनका office मेरे office के सामने है. So every day when I walk into my office, I look at his board, shit. So no, I think none of them is worse. I think if you follow your process, you will have both kinds of examples. You will have companies that work, and you've not invested in those. You will have companies that you have in your portfolio that don't work. I think those are the tail ends, and I don't think it should bother you too much as long as the median, most of your investments follow that process and are delivering the kind of returns that you expected. I think you're sorted.
Great. How do you evaluate unmarketed market? Like, for example, you say autonomous cars. So the market is blue sky, right? Every car can be turned out to be an autonomous car, whether it is for personal use or for business use, like taxis.
Yeah.
How do you see this as a market sizing and business model perspective?
Yeah, as I said, there are no easy answers. For any startup, this is actually a good example. Autonomous cars is a good example of a technology that's more or less now proven to work. At what scale will it work? We still don't know. Nobody knows at what scale will it work, because you need a lot of infrastructure around to ensure that autonomous vehicles can work in a safe manner, right? Not only transporting from point A to point B, but also making sure that that it is done in a safe manner and it doesn't kill a few people when it is going from A to B. So the way to assess this is actually, so again, I'm doing some crystal ball gazing, but I think it'll help everybody understand. So you look at what's the global market size for vehicles, right? And then suppose you are backing a company which is doing only passenger vehicles. So then you narrow down and figure, okay, what's the passenger vehicle market size, right? Of this, because this vehicle is autonomous, what kind of infrastructure will it need? Will it need a lot of guiding systems along the way? Will it need a separate highway to be made for these vehicles to ply? Is the state government or the central government, other government, whichever country you're talking about, is there budget to do that? So you got to think of all of these things when you're figuring out whether there's a sizable market or not. What are the unit economics? How much will it cost to put an autonomous vehicle on the road? And at what scale does the unit economics turn positive, right? And at that scale, do you have a market deep enough or number of people who will buy autonomous vehicles for whatever reasons they have? So you have to attack the problem. Just a good example, as I said, you have to attack this problem from a lot of sides and get all of these assessments and assumptions actually into a model to figure out what can be the market size. And then the startup that you're looking at to back, what are the strengths that these founders bring to the table to address that market size? How much capital do they have to back? Will they be able to deliver what they're promising, etc.? Technology, is it trademark? Do they have some IP in there, or is it just going to be coming from China or from somewhere else? So lots of questions there. Any business model, by the way, why I said this is a good question, it's like the easy one. That's why I answered Swapnil, otherwise I would have asked you to answer. But similar to autonomous vehicles, any startup addressing a new market is always like this. It's blue sky scenario. There is nothing to go by. You have to really make assessment of think of Steve Jobs and Apple, right? Or Mark Zuckerberg and Facebook. When they started, or Google, pick up any of those guys. When they started what they were doing, they had a vision that we will do this, right? Were they sure about how big will this be? No. Were they sure about whether governments will support it or not, whether people will like it or not, whether what they are doing on one campus, will it work on many other campuses or not? Will it grow? Will it grow from US to Europe to Asia to everywhere else? No, they didn't have a clear answer. Nobody has a clear answer, but you have a vision. And their vision was supported by some investors, right? So the investors have to have their kind of vision. The founder has to have his kind of vision. And that's how, magic happens.
Right. Now I have an interesting question, as we have touched upon Zomato during your discussion, that whatever Ashwath Damodaran had valued Zomato because mature company, cash flow as 40 rupees per share. What are your thoughts on the methodology? And as I have also closely seen capital market, nowadays most of the retail investors and are investing based on the gray market price. So some memes were floating around and got viral that Ashwath Damodaran by mistake have envisaged the gray market premium instead of the value of the company. So what are your thoughts in terms of valuation of a mature company like Zomato, who has been in the business, doing unit economics positive, so on and so forth?
Yeah. See, I think the beauty about a valuation exercise is that there's no right or wrong answer. And also we all know, and I think in the CFA course, this was drilled into my head when I did my CFA, is that price is different, value is different. So I think what Ashwath has done is valuation. He's valued the company based on his assumptions. Right, the price can be anything. In a bull market, the price can be 5-10 times what your value of the real company is. And in a bear market, it can be 1/5 or 1/10 of what the value of the company is. And you have to go no further than look at the small caps and how they moved over the last 2-3 years to understand, same company, same business.
Same.
In fact, धंधा बंद हो गया lockdown में, आधा हो गया revenues, but the valuation is skyrocketed 10 times, 20 times. So I don't think I would pass any judgment on what he said or what his. But I think it helps. So I've gone through his document, when he had put it out. I think if you look closely at some of the assumptions he has made, and I think it's a good idea for all of us on this call to really look at that document once again. So thanks for bringing it out, whoever asked this question. Tweak those assumptions according to what you think should those assumptions be.
And
right?
then look at
then see what is the value that you get. Right? And again, assure you, we are not trying to fit data here, but try to do an independent assessment and see what the answer comes out to be. It'll be an interesting exercise. It'll help you understand these concepts and really, really understand that ये assumption से कितना फर्क पड़ता
है. Right. Great one. So I am combining two questions. One is, what is the average ticket size one should look to invest? And where, as an investor or newcomers, they can look for deals? And is there any career opportunities for new charter holders in the space? Because everyone has learned investment management more from the public angle side, public market side. But there are very, obviously, off lately in India, we are seeing lots of VCs that are coming up. But if you see the VC industry 5-10 years before, there were very few funds that were there, right?
Right.
So what is the ticket size they should look to invest, and where they can find deals in terms of sourcing the right ones?
I think ticket size depends on the depth of your pockets. Right. I always recommend folks who are just about starting to look at the startup ecosystem. My recommendation is always that be clear why you're doing it. If you're doing it to really get involved with companies and work with them closely, etc., then by all means invest in startups. Please make sure when you start that journey, you have a plan to make 10 to 15 investments, not 1 or 2. Yeah, it's just diversification, and making 1 or 2 investments only will really not teach you what you're there to learn, right? So my recommendation is, please do maybe smaller ticket sizes, whatever is your portfolio size. You want to deploy, let's say $100, split that across 10 companies. You don't have to do $10 each, right? Some companies you have more conviction, put more. Other companies don't have so much conviction, put less, but create 10, 12, 15 companies in your portfolio from that $100. Second thing is, please don't do it all at once. Diversification is not only about having 15 companies, but also having companies across vintage. So spread it out, invest a little in year 1, year 2, year 3, make it a 3-year project for yourself. If you're there to learn, that's the first thing that I said, right? If you're doing all of this to learn, then I think this is a better approach. How do you find deals? Thankfully today, like Swapnil said, the ecosystem is much more robust than it was a few years back. So you have so many angel networks, right? I started doing this when we founded Mumbai Angels, 2006, when we started Mumbai Angels, and I was one of the early members. Now at that time there was only Mumbai Angels, and then there was Indian Angel Network. There was nothing else. Today there are tens of angel networks around, right? There's so many of them sprouting all over the place. Join a good angel network if you want to do this approach, right? If you have a larger ticket size and larger exposure, larger risk appetite to stomach, but you don't have too much time to get involved with all these companies, you're doing it from a portfolio allocation basis, my recommendation always is put money in a fund, right? Equanimity is the best fund around, as you know. So,
Yeah.
But if you are not going to get involved with these companies, right, please don't put little bit money and forget about it. It's, it won't yield a result. Go to a fund. You give them the money and let them do all of that. Because if you're doing it for portfolio management and portfolio allocation as well. If you're doing it to learn, don't give money to a VC. Become an angel investor, invest in these companies, spend time with them. There's too much to learn. You'll be amazed. So that's the answer to question 2. Question 3 was career. Right? As a CFA charter holder, what are the career opportunities? And I have some good news. In today's market, if you see over the last 10 years or more, private markets have got more capital from foreigners than public markets, right? Year after year, right? Every year. So it goes without saying, follow the money. Where money is coming into private markets, careers will also be there. And as you rightly said, Swapnil, there are so many private equity funds now, VC funds. They're mushrooming. There are so many AIFs that get filed with SEBI every month now. So too many career opportunities. Please keep your eyes and ears open. Use your networks, and there'll be. We always look at adding good people to the team, and I'm sure so does every other VC. So just write into them. We are all looking for smart folks around.
A follow-on question on that: what are the skills that are required to get into a VC space? Is IIM CA or IIT is the criteria?
So there are necessary conditions and there are sufficient conditions. Right? So having IIT IIM is maybe necessary, not just IIT IIM, but any a good educational background is necessary, but it's not sufficient. I think there are 2 aspects that if I were to give advice to my own self 25 years back, I would say, one is network. Right? You have to network with people, keep all channels of communication open, talk to people, be out there, put yourself out there. And the second would be, just follow your heart. If you should really love investing if you want to become a VC, right? If you don't really love investing and it's just a career option, this is a really bad career, right? Because the hours are very, very erratic. The money, there is a lot of money in the long run, right? In the short run, itna zyada paisa nahi hai. That's true because VCs and private equities, all private kind of funds. We are all incentivized by the carried interest that we make after the fund's life is over, right? So if you're not going to stick to a firm for a long time, ज़्यादा पैसा नहीं होगा, wealth creation नहीं होगा, job मिलेगा, you'll be a happy guy on the planet, but you won't have wealth creation opportunities. So if you really love this line of as a profession, then there's, in my opinion, no better career than investments. I would have my son that.
Yeah. I would have one more advice in terms of if they're looking to have it as a career option. Why don't you create something and showcase it to them in terms of, rather than saying I will apply, you ask them that why you shouldn't be chosen, right? prepare something, some note on we see the sector that is upcoming, like blockchain, crypto, so on and so forth, and then send it to a VC guy. Why don't you look at this sector as an investing opportunity? And showcase them something. They might like the idea of how you evaluated a startup or how you are positioning them in case they have not seen it already. And you have a great chance of what you can. And now the social network is all around that you can take advantage of.
True.
Anlin, can we, well, there is a question as to what are the sectors that you feel. So we'd want to put up a poll to that extent. What are the sectors that we see the value or the traction is going to be for future or maximum growth? Consumer tech, health tech, or fintech?
We'll wait for another 15 seconds.
Oh, as expected, fintech everywhere. Great. Rajesh, what is your view? Which sector you feel the maximum growth would be going forward? I know you have one or two investments in fintech, obviously.
Yeah. Yes, we have. So we are a sector agnostic fund. We invest across sectors. Fintech, we have a couple of investments. We are evaluating one more as we speak. We have investments in the other sector also that you mentioned in the poll. Yes. I think my view is, and it's always been that India has huge opportunities for only two kinds of businesses. There's no third category that I can think of. One is infrastructure, and the second is consumer. We are a consumption economy. Consumer is extremely important. And second is we are a country where infrastructure is just not there, or it just needs to be created all over the place. You just have to step out of your house to understand that there is no infrastructure, right? And whenever I give the example of infrastructure, there are so many areas that need a lot of capital and a lot of progress to be made. But as individual investors or VCs and smaller funds, I think we are not here to solve the infrastructure problem. We let the government handle that. They have those responsibilities and the capital availability, or let the larger financial institutions and firms, the DFIs, take care of that. But I think consumption, whether it is in the space of finance or it is healthcare, you can. So when I say consumption, I'm saying fintech, health tech, education. All of these are areas with amazing opportunities. As a founder, as an investor, it's just there for the taking. I'm extremely bullish on consumption in India, and I think over the next 10 years, we will have more than 10 times the unicorns that we see today. And I've been saying this, for a while. So there's too much opportunity out there. If you ask me to pick any one of these sectors that you list out there, I would go with consumer, rather than fintech. But that doesn't mean fintech doesn't have opportunity. As I said, our portfolio has fintech. We are evaluating one more as we speak to add to the portfolio. Sorry, too many opportunities. Just get involved.
Yeah.
Put your money and get involved with the company. If it's an ed tech that you like and it's it appeals to you, or it's a fintech, or just do it.
Yeah. Participants will take only one or two more questions. Rest we will try and answer it offline or probably reply to you by an email. Last few questions. Does a VC fund or investor really looking to care about investing in competing businesses? Let's say you have invested in EdTech and then you realize that there is a better company who is doing better things than what I had envisaged while investing. Let me back another one so that out of two, at least I have more probability or chances to get a success. And at a later date, might look to collaborate or put it together.
Yeah. So I think this is, it fringes on the border of conflict of interest for some funds. Again, depends on your fund's charter. But then there are enough and more examples of sector-focused funds where if I'm a fintech fund, I am going to do all fintech companies, right? So there is no conflict of interest conversation here because the founders who are part of our portfolio, if I'm a fintech fund, understand that there'll be other fintech companies here, and you have to then be someone who keeps an open mind and says, okay, there'll be too many opportunities for me to collaborate with other fintech companies in this guy's portfolio. So it's a meeting of minds. For a sector agnostic fund like ours, we have fintechs, we have edtech, we have consumer tech, etc. And so therefore, for us, there is very limited appeal to invest in a very similar business model again in the same portfolio. So I think it depends from fund to fund and their charters and what they're focusing on, what kind of portfolio they want to build.
And once you invest, is there what you can say, let's say you have invested in a consumer tech business, and then over a period of time, they realize that we have a lot of alternate data and let's start lending. And you already have a fintech business within the lending. So is your conflict of interest comes that way, or that is a passive, so that is okay?
No, there's no conflict of interest. I think that's, conflict of interest is something that we stay miles away from. Forget about conflict of interest. I mean, the standing instruction and the way we follow our investment process, there should be not even a hint of a conflict of interest. Forget about real conflict of interest. We don't want a perception of conflict of interest. So what we would do, and we've done in our portfolio as well, by the way, we'll put the two founders together. And we'll say, look, we think there is merit and we have a consumer business and we have a fintech, and we put, it's a good example. We actually put them together and said, yeah, हमको लगता है कि इसमें value create हो सकता है दोनों के लिए. But it's really your conversation, So we'll put them together, let them figure out whether they want to do it or not. And I think in that way, there's no conflict of interest, because if both of them
are, yeah.
Absolutely.
Great. Last question. What is the importance of technology? Would you look to invest in traditional business, which has a scalability and all, but not a tech angle to it?
So again, it will depend on the mandate of the fund. For our fund, technology is important. Our whole investment thesis is that we back innovative business models that use technology to build scalable and sustainable businesses. So we need an innovative business model. So you can't be saying, I'm setting up another pharmacy, right? Or another restaurant. There should be some innovation in the business model. And your business model has to be using technology. So technology has to be the backbone of what you're trying to do. To scale up and to build a sustainable business. So we do not invest at Equanimity. We don't invest in brick and mortar business, but there's nothing against it. I mean, as an angel investor, I've done enough and more brick and mortar businesses with myself. So we understand those businesses, but the fund's mandate is that you back tech-enabled businesses. So we are not a tech fund. We don't invest only in technology. We invest in real-world businesses that are backed by technology so they can scale faster.
Okay, great. So I have last question, which I will try and answer, and you can add if you feel anything I have missed out. So one person has asked, is the Shark Tank close to real life startup investing? So Shark Tank is real life startup investing, but there are, let's say, 2 hours of discussion scripted in a form that it will be presented to you in 5-10 minutes type of thing. And anyways, Shark Tank is coming to India, so people have more awareness and due to the advertisements that has been put up. So this is a real life investing, real life startup investing, but more scripted in a manner to showcase it to audience and make it more aware. Right, Rajesh? If I have missed.
Absolutely. No, absolutely. Of course. Absolutely.
Right. So we have, thank you very much, Rajesh, for the time and the agreement on extending the time also, because we have lots of questions. Still, there are some questions which we will try and answer offline and might need your help in answering few of them.
Of course.
Thank you very much, everyone. We have put up a poll in terms of how the session was and your feedback. It is really important for us to improve on things.
All right. Thanks, everybody.
You have been the wonderful audience.
Thanks, everybody. Thanks. This was delightful. I've gone through the list of questions. Very interesting. Thank you so much.
Thank you. Bye.